Good afternoon, everyone. I would like to start by thanking CI for giving me this opportunity to present on one of the most important topic uh, in the current environment. The presentation is structured into 4 different parts. First, we'll spend some time understanding the current environment and the government reaction or action being initiated with regard to corporate governance. We'll discuss few case studies on fraud to understand different kinds of fraud that we are seeing in the current environment. Then we'll focus a majority part of our presentation on what are the changes in Companies Act 2013 with regard to fraud risk management, right from definition of fraud, which has been introduced first time, to several other measures which have been introduced to enhance transparency as well as enhance corporate governance practices. And severe penalties have been introduced to make sure that organizations take this seriously and implement the act in its spirit as well. Then we'll spend some time in the end discussing some new methods being deployed by companies and organizations globally and in India for prevention and detection of fraud. So if we start with a recent press release wherein it was discussed that the ministry had ordered investigation into affairs of 152 firms in the last couple of years, and the finance minister in the Lok Sabha has clearly stated that the ministry ordered filing of prosecutions against companies, directors, officers in default on account of various non-compliances and offences committed under the Companies Act 1956 and other statutes as was recommended in the SFIO report. He also shared that a market research and analysis unit was set up within the Serious Fraud Investigation Office with the objective of analyzing media reports relating to financial frauds and for conducting market surveillance of such corporates. Now, this is something new as regards corporate affairs ministry is concerned. In earlier days, ministry used to mostly react after some complaint has been filed with them, or ROC had filed a specific report. But now, in the lines of what happens in the western part of the world, they are identifying proactively through media reports and through other channels information about financial frauds and conducting surveillance on such corporates before they actually take action. They also set up a forensic lab with appropriate skilled manpower, which is again a interesting development. When I used to interact with some of the individuals and then officers earlier, so they used to always say that they are challenged in terms of analyzing volumes of documents that are presented to them by corporates, or which they basically take when they do audits. But the forensic lab would help them process those electronic information faster and identify issues in a much in a much short duration than what was being done earlier. An early warning system is also being developed that would generate alerts and analysis and early detection of potential frauds, which would also include reviewing the financial statements being filed by companies. A lot of information today is being filed in electronic form. I think what the government is doing is that in most areas it's collecting information in a manner that can be analyzed forensically and analyzed electronically, instead of going through reams and reams of documents. So that going forward would help in proactive identification of potential frauds. So the next slide covers findings from a survey that we conducted in India, and this basically summarizes the kind of environment that we are currently living in, especially in a scenario where the economy has been on a downturn and off late on a volatile plane, wherein in one quarter we see a growth and then second quarter we see a decline. So some of the key findings from this survey were 74% of the managers mentioned that they are under increased pressure to meet targets of their investors and owners and deliver improved financial performance over next 12 months. This is a sort of a situation that keeps coming up whenever there is a downturn. The organization is not able to sell, but the targets remain the same. So the people who are supposed to meet those targets, the sales managers, the operations managers, and the others, are under tremendous pressure to meet those targets, which basically puts them into a situation of high pressure, and they start making the numbers rather than actually sort of doing the sales and doing the activities. So the pressure forces them to show a performance which is better than what it actually is on the ground. Especially if you consider the scenario on the personal compensation, is in most organizations, especially on the sales front, the variable component which is linked to performance is very high. So the incentive for people to conduct in an unethical manner in order to meet their targets is also very high. And as we go along the presentation, we will see some practical examples that have been reported in media, including with some of the best organizations which do have systems and processes in place, but still on account of the pressure that individual employees are in, they were forced to present a picture different than what was actually prevalent. Then 54% of the respondents often reported their financial performance as better than it is, which includes revenues recorded before they should be to meet short-term targets, underreporting of costs incurred to meet short-term financial budgets, and customers required to buy unnecessary stock to meet short-term sales targets with a view to meet the numbers. So here what is happening is that in most places where systems and processes are in place, organizations are trying to meet, at least on paper, the requirements of revenue recognition policies and then accounting standards and other requirements. But in spirit, in several cases, it is given a go by. An example is where an organization has a policy that revenue would be recognized after the goods are dispatched from the factory. So you will have a truck which is standing outside the gate of the company for even 2 weeks or 3 weeks after the quarter end or year end, but still the revenue is recognized because the truck has left the factory premises. So we have seen several of those cases where organizations or rather than organizations, individuals are trying to show that they have complied with the relevant requirements while meeting the targets, but in reality it is complied only on paper and not necessarily in spirit. Bribery and corruption, most people thought that after some of the movements that happened in India, bribery and corruption would have substantially gone down. However, the experience on the ground still sort of is contrary, and most of the people that we interact with still complain that bribery and corruption is still very high and it's widespread. In several cases, what people are saying is that it has in fact gone up. People who are taking bribes are still continuing to take bribes, and they are taking higher, and they are taking in advance on the pretext that the risk for them has increased after some of the other initiatives implemented by either government or other organizations. In terms of compliance programs, there is a disconnect in terms of what organizations believe that how their compliance programs are operating vis-a-vis the way they are operating on the ground. There is also a difference in perception in terms of how senior management looks at compliance programs vis-a-vis how the junior and middle management look at it. So if we summarize what is happening on the ground is that on account of several cases being reported in the media and several cases being reported to the government, so much so that CBI has gone ahead and increased the threshold at which cases can be filed with them. The government on a regular basis is receiving complaints with regard to various frauds that are happening in the market. If you turn any financial newspaper today, almost on a daily basis you will see some fraud or some scam getting reported in the media. So this has led to a plethora of laws either being amended or being introduced by the government in order to strengthen the corporate governance mechanism in India. Then we are also seeing action being taken against the individuals who are responsible for these acts. You would have seen examples of chairman of a bank being arrested, several other corporates, senior employees being arrested and put behind bars for various sort of potential scams and then frauds that were detected in the recent past. So the message from the government. So I picked up some of the recent direct messages which were passed on by the finance minister and the prime minister. In fact, Prime Minister, as recent as today, in his speech on Make in India, he spoke about the fact that rule of law should be there and corporate governance responsibility should be the norm. The finance minister in a recent conference pertaining to I think the Institute of Company Secretary called for greater corporate governance, and he said that there is a need for better transparency in financial records and the law will be tough going forward on the wrongdoers. He also stated that if there are any black sheep and they are identified, then let the law be tough on them. And he clearly said that companies deal with investors' money. Therefore, investors have a right to know each affair of the company. And what is interesting is that in earlier days, when we used to talk about public money, in most cases we used to talk about companies that are listed and which have raised capital in the equity market. But the New Companies Act has drawn a clear sort of a distinction, wherein it has also sort of made companies, those take deposits from the public as well as those take loans from the banks as companies sort of almost in line with public companies, even though they may not be public companies as per Companies Act, and they may be registered as private limited companies. So the concept of public money is extended, and it doesn't just cover money gathered or raised through equity, but it also sort of includes money borrowed from the banks. So let's spend some time on some of the key case studies, and we have picked up a few examples across different spectrums and industries, so that will help us understand the kind of issues we are seeing on the ground. So the first one is a case of a sensitive data theft, and these are increasing across industries, across organizations. In this case, there is a large subsidiary of multinational organization headquartered in India in New Delhi or NCR, and they are going through a high-profile M&A transaction, and the details or the nitty-gritties of those transactions were known only to the top 3 people in the organization, the CEO, CFO, and then the legal head of this organization. Even if any printout was required to be taken, it was taken in the legal head's cabin, and nobody else from the organization was aware of this, of the details of this transaction. But they realized that the information with regard to their bid and then the steps that they are taking was leaked to a competitor, and they no more had a first mover advantage in this transaction. So they were shocked, and we are called in to investigate, and they also provided access to the computers of the 3 individuals, the 3 senior individuals, as well as their smartphones, And when we analyzed the laptops as well as the smartphones of these three individuals to identify if any information was shared outside with others, or was there any trend in terms of interaction with anybody outside this group, we did not find any red flag over there. Then we went into the back end of the IT infrastructure of this organization and found that the CFO's email ID was configured in a way that the emails, besides being delivered to his laptop and to his smartphone, were also being delivered to another smartphone which was accessed by a person from the IT team. So today the emails are accessed and configured in a manner that you are able to access these emails through multiple channels. You may have three phones or an iPad or iPhone, and then a computer in office and a computer at home. So today you are able to access your information, official information, through different means. And in the back end, if it is configured in a way that it delivers it to an extra source, you would not even know unless you are monitoring it in the background. So too much of reliance on technology without understanding the loopholes and without understanding the gaps can also lead to frauds going undetected for a long time. An extended example to this is with regard to implementation of ERP systems within most organizations. Today, most of the organizations have one or the other ERP in place. And whenever we do investigations, especially around duplicate payments and then frauds, then when we ask the organization what is the sort of control you have in place, most organizations come back and say that, oh, we have ERP in place, we have a maker checker concept, and one person enters and the other person processes or approves. Then when we go and do a basic check, we find that the maker checker concept is not working because people are sharing their passwords freely. The same ID is being used by multiple individuals within a department in order to save license costs. Then duplicate payments are not being captured adequately because there are basic flaws in the way in which the ERP was implemented. For example, if you use an additional space and if you process a vendor invoice twice, it will not be picked up because it will not be identified as a duplicate payment as part of the audit report. And fraudsters being sort of smarter and always ahead of the curve, they understand the systems and controls better and identify the gaps and loopholes in those systems and controls and start using them first in a smaller way, passing a lower value transaction, so that even if they get caught, they can simply say that, oh, they did it with an error, and since the amount involved is small, the organization may not take any action. But if the transaction goes through and they don't get caught, then they start increasing the amount, and slowly you will find that the organization has lost a few crores or few millions by way of fraud. So over-reliance on technology without understanding the gaps in the technology can lead to frauds going undetected for long periods of time. So next is a case of a large tech company which sacked 24 people for overstating revenue. This was in July 2014. So these individuals were in sales, operations, and finance, were basically creating false orders, and even revenue from existing customers was overstated. So what they were doing is that they were forging customer purchase orders and diverting material sourced for customer deals to the open market, and through that process they were showing a performance that was better than what was actually on the ground. And revenue recognition is a constant issue, and the way the targets are set, the way in most organizations we have seen that there are month-on-month targets, there are quarterly targets, and you can always see a trend that majority of the revenues tend to happen in the last few days of the month or last couple of weeks in a quarter. We have seen innovative practices being adopted by the organizations wherein they disincentivize individuals who sell mostly in the last month of a quarter or a year or last few days of a month. Rather they incentivize more those individuals who sell throughout the month or throughout the quarter. So the way you implement your schemes and then incentive programs also determine the push that individuals may have with regard to fudging numbers. The next one is a interesting case where at least a year and a half back in Indian scenario we did not hear about regular recalls of vehicles. This was never there in Indian scenario, but since last July to now there are at least 12 cases of recalls done by various auto companies. And what we are seeing is a trend towards potential improper practices, which is going beyond financial numbers, and in these cases it actually can jeopardize the safety and lives of individuals. We are seeing this in auto industry. We are also seeing that in the pharma industry, where you are seeing regularly FDA inspections are finding that companies are not complying with the compliance requirements, and potentially the medicines that are produced may not meet the good manufacturing practices requirements. So a different trend is emerging wherein we are seeing a lot of compliance related issues because by nature or by culture we are more focused on the outcome rather than making sure that the process is also followed while achieving the outcome. So in auto industry we have seen cases where engines which are sent for testing are pre-tested and made sure that they would go through the testing process smoothly at the government certified testing institutions, which is actually not right, because you are supposed to send a random sample of engines to make sure that independently they are being verified. Similarly, we are seeing cases wherein the test results are not appropriately recorded within the organizations, and wherever test failures are happening, they are not recorded, but wherever they are going through, those are recorded in the testing data. Claims reimbursement. The reason why I picked this up is that the Companies Act throws a big, New Companies Act throws a big challenge in front of organizations. So how do you deal with scenarios where you have employees potentially fudging their reimbursement claims? Would you call it as fraud, and would you call it as would you be required to report it to the central government? The way the law stands today, yes, you will be required to report it to the central government. And it's a common knowledge that in several cases organizations have detected employees fudging either tax-related reimbursement claims or even conveyance and other reimbursement claims. And these issues keep coming up on a regular basis, and we are seeing that in a cycle they reach a peak and then slowly they taper down, but again pick up steam, and then in another year you will find that they again reached another peak, which is probably higher than the previous peak. So how do you deal with these instances which, say for an example, has 10,000 employees, and on a regular basis through their either internal process or external process they are able to detect potential fraudulent reimbursement claims? The one task is how do you prevent this, and second, even after you prevented it, some of these will happen because of the number of employees involved. How do you deal with those scenarios in terms of reporting to the central government? This is another case which is quite high profile in the public domain, wherein a large sort of organization involved in manufacture and distribution of footwear in India. There the senior management was arrested on the complaint of corporate fraud. Recruitment frauds, these are increasing, and we are seeing no sort of respite to organizations from these. Most people thought that in the current environment the recruitment frauds would have reduced because there are not that many jobs available. But we are seeing that instead of reducing, they are increasing because there are more number of people who are there are more number of people who are applying for less number of jobs, and the number of jobs that are available are reducing consistently instead of increasing. So we are finding people, especially in say tech sector and in retail sector, whose starting salary is in the range of 2.5 lakhs to 3 lakhs rupees, willing to pay an equivalent amount to get a job within an organization. And people are using different methods and schemes to get into an organization, sometimes using agents, sometimes using employees within the organization, sometimes using training centers who impart training in order to get into the organizations. And there are specialized firms and agencies which help employees get a experience certificate even though they may not have actual experience, and through which they can get into an organization at a level different than what they would ideally belong to. And people are so emboldened with this process that they continue to do this over a longer term. And we are also seeing a trend wherein even after this is detected, what organizations are doing is that they are asking the employee to resign and go, and the employee is able to find a job at a higher salary in the next organization and starts to continue with the same practices in the next organization as well. And one of the main reasons for that is no action is taken against the fraud perpetrator because of various reasons, including the long duration or long time it takes in an Indian scenario to bring a fraudster and get them arrested and then let them remain in the jail for a long period of time. So recruitment fraud continues to increase, and there are larger effects on account of this besides the bribery. In several cases, organizations are sending these employees to overseas locations, certifying their credentials, whereas those credentials in itself may be fraudulent. In several cases, even the background check verification is being manipulated by the candidates in collusion with the background check agencies or in collusion with the recruitment teams or recruitment consultants, which then can lead to much higher liabilities and penalties. Say for example, you certify and send few employees to say US, and while they apply for their visa, you are certifying the correctness of the documents that they are submitting. And tomorrow if they get caught and it is proved that the documents that they submitted were fraudulent, even the company's name and brand name would suffer a severe beating. We just last month released a survey. We conducted a survey across organizations on the current status of whistleblowing mechanism. A whistleblowing mechanism or vigil mechanism is one of the important measures introduced in the current Companies Act, New Companies Act. It was a non-mandatory provision in the previous clause 49 of listing agreement, corporate governance requirements. But as per the New Companies Act, it has been made mandatory for categories of companies. And what we found is that as of now in India, it is more a tick in the box approach because 22% of the organizations said that they implemented a mechanism because they realized the need for it rather than implementing it in spirit. There is basically minimum awareness with regard to the benefit of hotlines. Globally, it has been proved that majority of the frauds are detected through hotlines. Only 57% of the respondents said that they implemented a hotline in India. Then only 13% of the companies had whistleblowing frameworks which are fully in compliance with the New Companies Act. 50% stated that less than 25% of the complaints reported need for further investigations. That implied that majority were not within the scope of whistleblowing. So the awareness about whistleblowing is also not adequately spread. So a lot of HR related complaints start coming in from through the whistleblowing matter, whistleblowing mechanism, rather than ethics related complaints coming in, and an organization taking the right steps in order to investigate and prevent those frauds. So whistleblowing is an area where organizations need to take steps to enhance enhance awareness about the mechanism that they implemented, as well as implement mechanism in a manner that it is effective in dealing with the cases of frauds. Even though globally it has been proven, and this is the data from ACFE's report to the nations, where it has been clearly documented that organizations that experience fraud and which had hotlines, they experienced that the frauds were detected 50% more quickly, and the investigations were 41% less costly, because the frauds were detected before it could become a large scheme. So you are saving costs on both sides. One, the amount of fraud involved is lower, as well as the cost of investigation is higher. Once the scheme is run over a period of time, then the amount of fraud increases, and the amount or the time and amount that is required to understand the entire modus operandi and unravel the fraud is also higher if the scheme is running for a quite number of months or years. So why is there an increase in fraud and corruption recently in India? And it's so much increased of late. And a simple example that we give is how our team has expanded. We were 30 people in 2010-2011 in this team, which focuses on forensic investigations. We are 460 people now doing only forensic investigations across India. So in a matter of 3 years, we have expanded 11 times, and this team is occupied on investigations throughout the year across various locations in India. So that is a simple measure, and we are just one of the players in this field, and there are other similar players who are also have teams doing investigations. So the number of cases are increasing, the complexity of cases is increasing. Why that is happening? Some of the reasons that I could think of are: one, accepting fraud or corruption as cost of doing business. So whenever we talk about proactive measures, proactive reviews to be done in order to detect frauds and prevent frauds, most senior management personnel would come back and say that some fraud will happen. We know that we can't avoid it. We'll consider this as cost of doing business. But what the organizations don't understand is that in several cases, it's not just cost of doing business. It can actually derail the business. We have seen several cases where individual employees were able to transfer funds from company's bank account to their own personal or to employees or to their employees' relatives, bank accounts, ranging from few crores to even in one case 26 crores. And it is a direct transfer from company's bank account to the bank account of the employee or to the bank account of employees' relatives. In a large case with a bank, an employee was able to collect more than 400 crores from high net worth individuals in India on the pretext of collecting those for investment in a particular scheme, which will give a fixed return of upwards of 10%, which was not possible in fixed deposit schemes. So when we think that it is cost of doing business, what we don't realize is that we are not assessed what is the exact gap and what is the exact volume and value of fraud that could go on within the business, and in some cases it can derail the entire organization. Absence of policies and procedures, in some cases absence of communicating those policies and procedures which are aimed at preventing and detecting fraud and deterring frauds is also a reason for increase in fraud and corruption in India. Then attrition and lack of loyalty. Earlier, whenever employees used to join an organization, they almost used to join for their entire career. So you could go back and then see companies like say ITC, Tata's, or sort of HUL and then others, where an employee would join as a trainee and would retire at whatever level, sometimes at GM, sometimes at VP, sometimes at CEO level. But most of their career they will spend they would have spent over there. And you would have always seen that employees used to spend on an average 10 to 15 years in an organization. But now what is happening is that because of this culture of shifting jobs for hikes and for getting to next level, and less focus on experience and the quality of training and learning that employees are receiving, you are seeing the loyalty has also reduced. In addition to that, the attrition also puts a lot of stress on systems and processes because some employees who are there within the organization for slightly longer time and who have an intent to commit fraud, they are able to commit fraud easily because people who are in the controlling position, what they are doing is that they are not there for a longer time. By the time they understand what is happening, they're already in the next organization. So the employee who is there within the system understands the gaps in the system, but employees who are responsible for controls, they are changing their jobs quite frequently, which is leading to a vacuum in the control function and leading to frauds not getting detected in time and schemes being run for a longer period of time. The misuse of trust and responsibility. One thing that has changed is that the level of trust and then the level of levels of integrity. Earlier, if an employee has worked over a period of 8 to 10 years, you would basically think that the employee is very loyal, would not sort of do anything which will harm the organization. Over a period of time, the overall moral fabric of the society has degraded. Today, people don't think wrong in terms of doing a fraud within an organization in which they are working. So what is happening is that the earlier concept that an employee who is there in the system for 8-10 years would normally not commit fraud, that has sort of almost gone away, and you are seeing employees who have spent a longer time, had a lot of independence, are closer to promoters, also committing frauds, and in several cases committing high value frauds. So what is the message that is coming in from the government? Like we sort of discussed earlier. So there are two things that are sort of worth repeating over here. One, the rule of law should be there. Not just good governance, but effective governance is also required. Like FMS said, which I explained in the earlier part of my presentation, if there are any black sheep and they are identified, let the law be tough on them. So the government consistently has clarified that they would go after individuals and companies who are not following the corporate governance norms and are duping investors or banks or others. And there are enough examples that are available in the last 3 to 4 months where the government agencies have gone after specific organizations where there is a complaint of defrauding either the investors or the banking system. So now we would move and discuss for next half an hour the key changes in the Companies Act and what is its impact on fraud risk management. For the first time, the word fraud finds a direct mention. While it has not been defined in the definition section, but if you go to section 447, which defines punishment for fraud, there the term fraud has been defined as fraud in relation to affairs of a company or any body corporate, includes any act, omission, concealment of any act, any fact or abuse of position committed by any person or any other person with the connivance in any manner, with intent to deceive, to gain undue advantage from or to injure the interests of the company or its shareholders or its creditors or any other person, whether or not there is any wrongful gain or loss. Now, if you read this definition at a holistic level, it is so wide, and that even if a fraud may not have actually been committed and an individual may not have actually gained anything, but still that individual and the organization can be prosecuted if it is proven that there was an intent to deceive in order to gain an undue advantage. A classic example here is the case which happened with the Indian national in Canada recently, wherein the Indian national was prosecuted by Canadian authorities and it was upheld by the courts. And in this case, the allegation was that the employee through his organization had bid for a project with the national air carrier in India, and even though the person did not win the contract, but evidence was noted that if they would have won the contract, they would have bribed certain officials for helping them win the contract. Even though there was no actual bribe that was passed on, there was no actual act or benefit that was derived, still the person was prosecuted and the court upheld that prosecution. So the act is so wide that it covers all kinds of activities. It covers situations wherein the loss may not be to the company but only to the creditors. And it is again so widespread that whether it is an employee who is committing a fraud, a vendor who is committing a fraud, or a third party who is committing a fraud can be brought into the jurisdiction of the Companies Act. In terms of penalties, whether under section 447 or in other sections, the penalties have been increased multifold. For example, under the new act, the penalty for fraud is imprisonment for a term which shall not be less than 6 months or which may extend to 10 years, where it involves public interest. Then the amount shall not be less than the amount involved in the fraud, but which may extend to 3 times the amount involved in the fraud. So, so one advantage of doing this is that it will act as a big deterrent in the minds of organization and then people, so that they would implement strong measures to prevent and detect frauds. Then these are cognizable offences, and a person accused of any offence under these sections cannot be released on bail or on his own bond unless it is subject to some exceptions provided under section 212(6). Then penalty for insider trading, it is increased to 25 crore rupees or 3 times the amount of profits made out of insider trading, which is higher or with both. Now what is interesting over here is that till recently or even till now, there has to be extreme sort of proof, extreme trail available for insider trading cases. But going forward, what we are hearing, that even if there are circumstantial instances wherein it is proved that the individual had access to non-publicly available information, and that information was used either by that individual or by somebody else known to that individual in order to trade in the stock market, then those people can be penalized under the insider trading guidelines. So which would be interesting to see, because in US that is already prevalent. One of the most high profile cases in US had just circumstantial evidence available, wherein the director in this company attended a board meeting, say at 10 o'clock. After the board meeting, which got over at 11 o'clock, he made a call to his friend who was an investor at 11:01 a.m. At 11:10 a.m. that investor invested in the stock of that company, and just based on this evidence, the person was put behind bars for 2 years. So adopting some of the international methods which we are seeing consistently being adopted by enforcement agencies in India, and of late the enforcement agencies in India are also being trained by Interpol, by FBI agents, as well as by SEC and DOJ employees. So they are using more innovative methods in order to bring culprits before the law. In terms of auditors, the responsibility is quite onerous. IC has already approached the government, and there are interactions happening in order to make certain amendments so that these provisions become more implementable from a practicality perspective. For example, as of now, an auditor is required to report even a 1 rupee, fraud that is, detected, and irrespective of the action taken by the, company, the auditor is required to submit a report to the central government within 60 days from the date the act is, detected. The liability to the auditor is again very high. The auditor is liable under section 447, where the auditor is the firm and partners or partners have acted in a fraudulent manner. Liability for such act will be of the partner or partners concerned and of the firm jointly and severally. Provided further that the auditor, whether individual or firm, shall not be eligible to be appointed as an auditor of any company for a period of 5 years from the date of passing of order under the section 145. So the requirements are very onerous, and it also puts auditors in a very delicate, situation. In most of the developed, economies, as well as say Western, jurisdictions, the auditors are required to report only in a scenario where the fraud is material and where the organization has not taken, appropriate action. In those scenarios, they are required to report to the regulators and enforcement agency. However, in India, an auditor would be required, based on the current law, to report even in a scenario where the organization has already taken action and the amount of fraud involved may be, minuscule or non-material. Independent directors, the responsibilities of independent directors have increased tremendously, right from implementing systems and processes on risk management, prevention of fraud, overseeing the vigil mechanism, implementation and monitoring, to making sure that the financial statements are depicting a true and fair picture. The responsibilities of independent directors have increased manifold, and we are already seeing a completely different approach being adopted by independent directors when they are dealing with situations of fraud. And I'll explain you two scenarios from the same organizations same organization that we have dealt with. It's a large organization based in west of India, and we have been helping them with various investigations on a regular basis. Earlier, for small employee fraud related investigations, the internal audit team used to do an investigation internally and present it to the board and independent directors. And in most cases, that was accepted unless the scheme was complicated. This was before March 2014. In May 2014, they discovered a fraud in terms of procurement related kickbacks by an employee, and the internal audit, as usual, conducted the investigation and presented a report to the audit committee. And independent directors started asking them questions in terms of, how do you know that this is the only case and there are no other cases? Did you do computer forensic to identify who else is involved? Did you perform forensic analytics on other vendors to confirm that there are no other patterns and this is the only case of fraud? So the management was completely taken aback, because for a very similar case 6 months back, the audit committee accepted a report that was presented by internal audit, and the internal audit conducted an investigation following the same methodology in May 2014, but that was not accepted by the board, and they ordered a full-fledged independent investigation. That is an additional power that has been provided to the independent directors wherever it is required, whether for risk management purpose or for forensic purpose. They have authority to appoint an independent agency to help them cover those areas, and at the cost of the company, those independent directors can guide the external experts to conduct investigations or to come up with specific information that the independent directors might need. So what organizations will be required to do in this scenario is that improve the existing risk management procedures as well as fraud investigation procedures. Otherwise, when they go back to the board, they may have to restart the entire process, because the independent directors may not accept what has been done, which in a way was acceptable probably before March 2014. So what are the different actions? So what is interesting is the number of times the word fraud has been used under the new act, right from registration of the company, incorporation of the company, misstatement in prospectus, fraudulently inducing persons to invest money. So there are at least sort of 30 plus sections where this word has been used, and right from sort of the documentation that are produced in relation to the company to various steps that are required to prevent and detect fraud. So clear emphasis has been sort of added in the act with regard to what the organizations need to do in order to prevent and detect fraud. So if we now look at serious fraud investigation office, so I'm not sure how many of the current participants dealt with SFIO earlier, but earlier till this new act was introduced, even in say a large case like SFIO has very limited powers in terms of taking action. What SFIO used to do is that when a case was referred to them, or in certain cases, very few cases to Yomoto, they used to carry out independent review and present the report to the ministry. They did not have direct powers to take action, which has been completely changed under the new act. It is now on par with any other sort of enforcement agency, similar enforcement agency across the world. There is a specific and a clear statutory status conferred upon SFIO. SFIO will have power to arrest in respect of certain offences. They can do dawn raids. They'll have a power to search and seizure. When SFIO is investigating a case, no other investigating agency will proceed in the investigation, which actually, if you ask me, is a positive development, because as of now, what was happening was that whenever a case was being reported in public domain, different investigating agencies would land up at the company premises and start opening up their own case. One live case that we ourselves saw recently was where we were investigating a case that I earlier referred on the footwear company. 8 different enforcement agencies landed about there to do their own investigation, because whenever any large scale fraud happens, there will be a violation of say Companies Act, there will be a violation of Income Tax Act, probably Excise Act, Sales Tax Act, maybe Environmental Act, and different other acts would come into picture. So different agencies start their own investigation, and which can also actually jeopardize the outcome of that investigation process itself. So what would happen going forward is that if SFIO has initiated an investigation, then no other investigating agency will proceed till the investigation is completed by SFIO. The investigation report filed by SFIO will going forward be considered as report of a police officer. Then SFIO has right to share any information or document with an investigating agency, income tax authority, in respect of any offense investigated by them. This is again an interesting development, because till now there was very limited information being shared between investigating agencies in a structured manner. It was all left to the respective official who is responsible for that particular case to determine to which department that officer will inform in terms of any other violations that they are noted while doing their own review. For example, if SFIO notes a violation of Income Tax Act besides the Companies Act, they would be entitled and have a right to share the information with the income tax authorities. Similarly, if they find any revenue leakage, they will have a right to inform Directorate of Revenue Intelligence for that. Or if they find that there are money laundering law related violations, then they can inform Enforcement Directorate or RBI as appropriate for taking necessary action. What SFIO is also doing is that they have hired experts. Several of them have been deputed from other organizations. Some have joined from private sector as well. And they are experts from banking, corporate affairs, taxation, forensic audit, capital market, information technology, and law. They also set up a forensic lab, like I explained earlier, and a market assessment and research unit, which will evaluate proactively cases of potential frauds and potential corporate governance violations. So unlike earlier days where organizations used to file, for example, a different financial statement with a banker to obtain a loan, a different financial statement with an investor to obtain investment, different financial statements, say with FCRA, to obtain foreign funds. I think where these three were not matched in all cases, going forward, what would happen is that there would be a proactive review of various financial statements and data being submitted through various organizations and through various enforcement agencies to identify if there are substantial differences between what is being filed with a bank or with, say, income tax department or with ROC. At present, there is no structured process to do that. Certain individuals do this based on their own interest or specific information and cases, but it's not a structured process. Going forward, it will become a very structured process. Vigil mechanism. So this is this was there earlier as a non-mandatory requirement under clause 49 listing agreement requirements, but now it has been made mandatory for every listed company, companies which accept public deposit, and companies which have borrowed money from banks and public financial institutions in excess of 50 crores. Like I explained earlier, the concept of public company is now not just a company which has borrowed money from public or raised money from public. It is also applicable to companies which have accepted public deposits and private companies which have borrowed money from banks and public financial institutions in excess of 50 crores. So if you are an organization which has say a working capital limit with a bank of 50 crores, even though you might be a private limited company, but this requirement is applicable to you. The audit committee is required to oversee the operation of the mechanism. Either they need to do it directly or appoint a member of the audit committee to oversee the implementation as well as operation of the mechanism. Then the company needs to provide adequate safeguards against victimization or retaliation for persons who use such mechanism. This is very important. So unless organizations do this, people will not be willing to come forward and complain. So a proper environment needs to be created wherein employees are encouraged to come and report wrongdoing without fear of retaliation and victimization. This is one of the most important measures formally captured as part of the vigil mechanism requirements. Then the company has to make provision for direct access to the chairperson of the audit committee in appropriate or exceptional cases. For example, where the complaint relates to, say, the CEO or the managing director or CFO of the organization, then an employee or vendor or any other whistleblower may not want to report through a normal hotline or vigil mechanism and may want to report directly to the audit committee or audit committee chairperson. So the vigil mechanism should provide clear information about access to the audit committee chair or the nominated audit committee member in exceptional circumstances. Then disclosure of details of establishment of such mechanism by the company on its website, if any, and in the board's report. Both in the board's report as well as on its website and internet, they need to include details of the vigil mechanism and the method of accessing the vigil mechanism. Then audit committee and the director or the director to take suitable action against repeated frivolous complaints. If the audit committee or the nominated audit committee member finds that a particular employee or a particular member is continuously complaining, and those complaints after investigation turn out to be frivolous, and it's creating more nuisance with an organization, then they will have authority to take action against that complainant as well. So there is a very fine line that needs to be drawn over here, so that while you take action against frivolous complaints, but at the same time you should not pass a message that if you complain in good faith, and if the complaint turns out to be incorrect understanding of a particular situation, then you would be taken to task. If an employee is submitting a complaint in good faith, then it should be sort of not considered inappropriate, and no retaliation or a victimization should happen of that person. What will be the impact on the companies? Companies will have to develop and implement a vigil mechanism, including policies and procedures to whom it is applicable, and under what scenarios people can resort to complaints to the vigil mechanism. They need to have a fraud response plan which will incorporate clear responsibilities as well as procedures. Once a complaint is filed as part of the whistleblowing mechanism, how that complaint will be dealt with by the compliance team or by the investigation team, and what is the kind of response that needs to be given to the whistleblower, what is the kind of action that needs to be taken against the people who are responsible for fraud, what remediation needs to be undertaken in order to make sure that the same fraud doesn't happen again. All that needs to be defined as part of the fraud response plan. Then company will have to conduct training and awareness sessions for employees in order to make sure that they are aware of vigil mechanism, and there are different ways and means in which you can create this awareness. For example, some of the innovative ways used is in some cases just on the reverse of visiting cards in the initial phase when the organization implement this, they also print the whistleblowing details, key values, and the whistleblowing or the vigil access details, or the screensavers that are there whenever sort of you log off from a system, or if the system is inactive for say 15-30 seconds, you get a screensaver. So that screensaver could be a message which creates awareness about vigil mechanism. So there are different ways and means and innovative methods through which you can create awareness about the vigil mechanism. Then there should be clear documentation available with regard to the mechanism and cases where reported concerns are captured. As regards independent directors are concerned, they need to ascertain and ensure that the company has an effective and adequate, functionally vibrant vigil mechanism. They also must ensure that the interests of a person using this mechanism are not prejudicially affected. Role of independent directors, like I explained earlier, as part of Companies Act as well as the revised clause 49, the role of independent directors is significantly enhanced, especially with regard to corporate governance requirement, what they need to do around risk management, what they need to do around implementation of vigil mechanism, what they need to do about prevention and detection of fraud. Some of the key requirements are helping in bringing an independent judgment to bear on the board's deliberations, especially on issues of strategy, performance, risk management, and standards of conduct. Satisfy themselves on the integrity of financial information and those financial controls, and the systems of risk management are robust and defensible. Now, this is a very important requirement. It encompasses the overall risk management systems and processes, which also includes fraud risk management. Where required, they can seek appropriate clarification, professional advice, and opinion of outside experts at the expense of the company. For example, if an organization carries out independent or internal fraud risk assessment, and independent directors are not happy about it or not comfortable with it with regard to the coverage and then the depth, then they can ask the company to get an independent agency to validate and do a second level check to confirm that what has been covered is appropriate and there are no significant gaps which are left unaddressed as part of the internal process. Where there are concerns about running of the company or a proposed action, they need to ensure that these are addressed by the board, and to the extent they are not resolved or they disagree, then their concerns should be recorded in the minutes of the board meeting, and they need to insist on that. So if you see, a lot of these are coming out based on experience from some of the large scandals or corporate level frauds that have been detected in the last 4 or 5 years, including starting with Satyam. So a lot of experiences from those scams as well as some of the global practices have been incorporated to make sure that these requirements are comprehensive as well as will help in enhanced corporate governance requirements. Then they need to keep themselves well informed about the company and the external environment in which it operates. If I link it with frauds, they need to be familiar with what frauds are happening within that industry, and they need to confirm whether a similar fraud can happen within that organization. An example is, if you are say in a pharma company and you are seeing some frauds are being reported with regard to say a manufacturing process, or with regard to say how solvent is handled, or with regard to how procurement is handled, then you need to sort of as independent director confirm that the organization on the board of which you are an independent director does not have similar issues, or the risk is addressed proactively within that organization. If you are an IT company and you're seeing a lot of cases of data theft being reported in media, you need to confirm what systems and processes are in place to prevent data thefts and data frauds within your organization. So it is important that the independent directors are fully aware and well informed about what is happening within the industry and within the company, so that they are able to take proactive measures and suggest proactive measures to prevent any significant frauds or prevent any significant issues that the company might face. Vigil mechanism we already talked about. Then report concerns about unethical behavior, actual or suspected fraud or violation of the company's code of conduct or ethics policy. Now it has not been made clear to whom they need to report. They need to report only to the board, or they need to go back and report to the central government. That clarity has not yet come in. Because if it is required to be reported to the central government, then it will be an added responsibility on the part of independent directors. And unless it is clarified what kind of concerns needs to be reported, it will create a scenario wherein even a 200 rupees sort of incorrect claim may have to get reported to the central government, very similar to the issue that auditors are facing in the current scenario. Penalties for contravention, where they are liable for contravention in respect of such acts or omission by a company which had occurred with their knowledge, attributable through board processes and with his consent or connivance, or where he had not acted diligently. Now the last sentence is very important. So what the law expects is that independent directors would take proactive measures and act diligently before they approve any proposals, before they approve, say for example, internal audit reports. In some cases, there is a very robust process in terms of how the internal audit reports are dealt with. Internal auditors are allowed to present to the corporate management. In some other organizations, the internal auditors are not allowed to present to the audit committee, and mostly it's the management that presents to the audit committee. So in some cases, the audit reports are attached to the board deck, and then the audit reports are not necessarily read in detail. Going forward, the independent directors will be required to take active interest in these areas to find out in detail if something is happening which is of concern, either from a governance perspective or from ethics and integrity perspective. We are already seeing a different trend where audit committee members or the members responsible for specific areas within the audit committee are doing proactive meetings, pre-audit committee discussions, pre-audit committee calls, to familiarize themselves fully with the issue on hand and making sure that they are getting into the details and not just relying on what has been presented to them. So which is, I think, already started in several organizations, and that is in a way helping organizations also to strengthen their own mechanisms. Moving to the role of CFOs, it's the first time that the word CFO has been defined, formally defined, and CFO's responsibility has been substantially increased, wherein it is now mandatory for a CFO to sign the financial statements, which was not there earlier. Most people used to do it by choice, but now it has become mandatory as per Companies Act. In a way, it was mandatory for listed companies to provide a CEO CFO certification as part of Clause 49. But now under Companies Act, CFO will be required to sign off on the financial statements. CFO is also identified as one of the key managerial persons or key personnel. So all the penalties that are applicable to key managerial personnel will apply to the CFO. So the responsibility of CFO has increased tremendously and is more direct now than what it was earlier. In most large companies, CFOs were already doing a similar task, and they were signing off on the balance sheet. But in several mid-sized companies to few other companies, the practice was slightly different, wherein while the CFO was responsible internally for financial statements and books and accounts, but when it came to sign off on the balance sheet and financial statements, in several cases it was signed off by the promoter directors or other directors and not necessarily mandatorily by CFO. So CFO now I think is responsible to ensure that financial statements of the company give true and fair review, then they comply with accounting standards, they are in the form or forms as prescribed for different classes of companies in Schedule 3, then financial statement is laid before the members at the AGM, consolidated financial statements is prepared in case of one or more subsidiaries, then the financial statements specify reason for deviation from accounting standard and effects arising out of such deviations. They are also required to sign the financial statements including the consolidated financial statements after the same is approved by the board for submission to auditor for his report thereon. Then they are required to ensure that the signed copy of every financial statement including consolidated financial statement is issued, circulated or published along with a copy of any notes annexed to or forming part of such financial statement, the auditor's report and then the board's report. So there are a lot of disclosures required. I was reading one article recently. Would disclosures help? The answer is not necessarily no, because I think there can be more and more disclosures. Instead of a 10-page annual report, you might get a 50-page annual report, but I'm not sure whether people have patience to read those 50 pages to identify the fine print. So I think what will be important going forward is to make sure that the fine print is identified distinctly and is captured in a probably a bold manner or different manner, so that it's more visible than other sections in annual report. The way I see this is that come April 2015 or May 2015, we'll see bulky reports wherein people may not have the patience to go through those reports and understand the fine print within those reports. So how do we improve the mechanisms to prevent and detect fraud? So I'll start with a statement that was made close to 2,400 years back by Chanakya in Arthashastra. So while talking about fraud and corruption, which is interesting that even in those days, 2,400 years back, Chanakya succinctly captured different kinds of frauds that can happen in an administration. And even today, most of those that were captured in Arthashastra still are prevalent. Probably we added few more because of the developments that have happened on the technology front. But whatever frauds were captured in Arthashastra in 2,400 years back, they still continue to exist. So he says that it's just as difficult to detect an official's dishonesty as it is to discover how much water is drunk by the swimming fish. So it's an interesting statement wherein what he means in a current environment, say in a corporate environment, is that if you are given an employee or a director or a management personnel an authority, and that authority is misused, so it is not an easy task, because the person who is bestowed with the authority or responsibility, if that person is itself is himself or herself involved in an act of fraud, it's very difficult to detect. So the challenge is not simple for all of us, especially considering the complexity of the organizations today, complexity of the transactions that we have today, complexity of the systems that we have today, where there are multiple systems used, transactions move from one system to the other, and in lot of cases we don't even understand how the transactions flow in the back end. So in that scenario, it's not an easy task to detect the frauds that are happening within an organization. But let's go through some of the leading practices. First, focusing on what is expected from a Companies Act perspective, and then we'll spend some time understanding what are some of the new methods being used by the organizations for fraud risk management and prevention and detection of fraud. The first and most important step is to create an anti-fraud environment. You need to create an environment where fraud is not tolerated, which means you need to set the tone at the top. If the tone at the top is not clear, if the tone at the top is not good, then it will be very difficult for you to implement an effective code of conduct and a visual mechanism and effective fraud risk management system in place. If employees believe that senior management themselves are involved in fraudulent behavior, then even if you go right in the open auditorium and tell them that these are the practices which are not allowed, but in the back end employees see that there are a lot of improper activities happening which could be even related to say frauds against the government, frauds against tax laws, then the employees get a message that it's more a lip service than a real sort of strong corporate governance mechanism. So setting the tone at the top is the most important step in creating a anti-fraud environment within an organization. Then effectively communicating the same to the stakeholders through an anti-fraud policy, code of conduct, and focused training is the second most important step. One is to have a clear tone at the top, and second, people should be aware that the tone at the top is clear and then clean. In several cases, employees at middle management level take advantage of lack of clarity in the tone at the top by saying that I am doing this because I have a diktat from the senior management. Senior management may not have told anything, or the promoter CEO would not have told anything in terms of any specific activity, but the middle management might be doing it by referring to the name of senior management, and a junior management or external vendor do not have either access or guts to go back and raise this with the senior management, and they always think that they are doing it because it is required by the senior management. So unless you clearly communicate the tone at the top through a anti-fraud policy and a clear code of conduct and training, it will be difficult for you to prevent frauds which are misrepresented as acts of push from the senior management. Then aligning performance and ethical conduct. This is also very important. In several cases, we have seen that the KPIs include mostly around what needs to be achieved as performance targets. This is the production that needs to be achieved. These are the quality standards that needs to be achieved. This is the sales target that you have. But those needs to be combined with compliance on the ethics side as well. The target needs to be met while complying with the ethics and code of conduct. Then it makes sense to an organization. Otherwise, if the message is that irrespective of what we have as a code of conduct on paper, what I am more bothered and worried about is performance, and you would be measured based on performance rather than ethics and code of conduct, and it will not have any impact on your performance appraisal. There is very limited incentive for individuals to comply with the code of conduct, and they will be tempted to meet their performance goals without actually meeting the standards set on the ethical and code of conduct side. Then second one is establishing procedures for prevention and early detection of fraud. Even though you would have set a anti-fraud environment, but any organization is like a colony or like a city or a village where you have so many people, and if you have say 300 people or 500 people or say 5,000 people within a village, city or locality, you would have all kinds of people over there. You will have people who would abide by the law. You will have people who would look for an opportunity to do something wrong provided nobody is watching them, or you will have people who would be habitual offenders and who will continue to do whatever they want irrespective of the rules that are there in that locality, city or in a village. So similarly in an organization you will have all those different categories of people. So we need to make sure that in addition to clearly communicating anti-fraud policies, code of conduct and tone at the top, you also need to have measures which will act as deterrent for prevention for commitment of fraud. And these can be done through formal fraud risk assessments, fraud controls monitoring, background checks, which are very important measures. And what is happening on background checks is quite interesting, and we are seeing this regularly on the ground because what we are seeing is that most organizations have outsourced their background check process, without actually reviewing the efficacy of that background check process. In several cases, the kind of amount that is paid to background check agencies is in the range of 200 to 500 rupees, and it is expected that those agencies will carry out a thorough background check at that cost. In several cases, when you go and do a review at those background check agencies, you will find that they are not actually doing those steps, and they are actually just filling up the reports and sending, because it is almost impossible for them to carry out the checks prescribed by the customer in order to verify the clear background. An example is, say, police verification, and these cases have come out in public domain as well. Going and obtaining a police verification report formally takes anywhere between 3 to 5 days for each case, and you need to go multiple times to get that, and you need to get that without payment of any bribe, right? So it takes at least 4 to 5 days minimum to do that, and each jurisdiction the process varies. So what was reported in the media in this particular case was that this background check agency, they were themselves printing the police verification report and then submitting it to the company, and this has all come out in the media in few months back. So what is important over here is that we should not just implement systems, processes more to tick the box. Rather, we should understand how that particular system and process is operating, whether it is operating effectively or not, and whether it is yielding a desired result or not. This should be followed up with mystery shopping or surprise audits, wherein you are trying to see whether the systems and processes you have in place are working in the manner that they are supposed to work. Most of the times the fraudsters are fully aware of the audits and then the routines and the sample selection process, and I'll give a classic example over here. Most audits select a sample as of quarter end or as of year end, or few days as of quarter end and year or year end. So we have seen cases wherein dummy vendor accounts or dummy customer accounts are created on, say, 30th of May, and then closed next year before 31st of January, and a zero balance is shown subsequent to those dates because the sample selection happens between January and April. So, and that is known consistently. So the audit process is known pretty well. The checklist is sent well in advance, so the auditee is aware of what is going to happen. For a normal auditee, it is fine, but a person who is committing fraud will make sure that he or she is following a process which will be difficult to detect through a normal audit. So therefore, doing some surprise audits on a regular basis is important. Doing an audit without announcement is important. Doing mystery shopping, which is basically penetrating the system, is very important to identify if something is happening on the ground. And this also acts as a deterrent. Fraud analytics, I'll discuss that this in detail in the next few slides. Establishing a vigil mechanism, we already discussed in detail. Then establishing fraud response procedures, escalation and investigation protocols. This is important, especially I'm not sure how many of you have followed the Supreme Court judgment on 21st of September 2014, which is just 3 days back, where Supreme Court has said that any electronic data which is produced in front of them as evidence should be certified in compliance with Section 64B of the Evidence Act. Now this requirement was not there earlier, or it was not clear earlier, which means that a copy of the document taken on a pen drive or a CD will not be admissible as evidence in court of law. So you need to make sure that your investigation protocols clearly capture the process that needs to be followed for conducting an investigation, for creating an evidence, for presenting an evidence, especially in a scenario where you want to take a regulatory or a legal action. Then discipline and compliance enforcement, which is very important. At the minimum, we suggest that organizations should at least terminate clearly with cause where employees have committed fraud, even if they decide not to proceed with criminal action. Unless they do that, they would not be setting a example within the organization, and the next person will start committing fraud. And we have seen very interesting cases over here, specifically on this matter. And I'll share one classic example from an investigation that we did with a large auto company in South. And we are called in to investigate in 2013 June a case of logistics fraud, wherein the employee who was responsible for logistics was creating dummy transport vendors bills, and in collusion with the transport vendor, he siphoned out close to about 2 crore Indian rupees. And this was detected. We investigated. We found the evidence. The majority of the amount was recovered, and the employee was asked to leave. And within 6 months, they got another case in the same department. And what was interesting in this case was that in the previous investigation, a person from the operations was involved in helping with the investigation process. And that person, since he gained familiarity with the logistics process, was given the responsibility of the logistics process. And this person, within a month, started doing a fraud of very similar kind. And when he was confronted, he said that since I did the investigation, and since the investigation happened just a month back, what I thought that nobody would doubt that I will commit a similar fraud and no investigation will happen again. So that individual basically thought that if I do the same fraud, I could make money, and he actually made another crore and a half through that process. And what worst would happen is the organization will ask me to leave if it gets caught. So the deterrent is very minimal. The enforcement is very minimal, which helps the person who is committing the fraud to continue with his or her act in organization after organization. Then if you look at the process that needs to be followed in terms of control remediation, we are seeing cases where even after issues have been discovered, the systems and processes are not changed across the organization to prevent those kind of frauds. The next slide, which we are on now, summarizes how a fraud risk management framework looks like. We have rarely seen an organization which is sort of capturing all the efforts done by various departments into a single document. We have seen some of the larger organizations starting to do that. We have worked back with some organizations to put this kind of framework in place. But this framework summarizes what is required from a fraud risk management perspective, creating an anti-fraud environment through various measures that we discussed in the previous slide, creating procedures for prevention and early detection of fraud, and then having fraud response procedures. Now let's look at some of the new methods that are emerging for prevention and detection of fraud. First is data analytics, and data analytics can be done through different ways. One is forensic lookbacks, and when I talk about forensic data analytics, one of the questions that comes up is how is this different from other data analytics? My personal view is that it is similar to other data analytics that you would do to the extent of 60%. Why it is different in terms of 40% is with regard to the purpose for which you are doing this data analytics. When you are doing data analytics, say for sales, you are doing it more to understand consumer behavior. When you are doing it for, say, purchasers, you are doing it from a cost reduction perspective. When you are doing it for internal audit, you are doing it for selecting a sample. When you are doing forensic data analytics, you are doing it to identify red flags which indicate potential fraud that is happening and potential pattern that exists with regard to a fraud. Different ways in which forensic data analytics can work is through lookbacks. Lookbacks is the process wherein you look at transactional and master data for, say, last 1 year or 2 years to identify inappropriate transactions. So this is sort of post-mortem exercise wherein you are trying to identify, say, duplicate payments from, say, last 1 year payment data or AP data. The second one is continuous transaction monitoring, wherein you are doing this proactively before the actual final payment has happened or before the actual transaction gets consummated, so that you are able to identify online a potential fraudulent transaction. Then anti-corruption and compliance data analytics. So a lot of advanced methods have been evolved over the last 5 to 6 years in doing anti-corruption analytics. Today, you can sort of by running these analytics tools within a week or 10 days on the entire data, you can start identifying trends if there is any significant corruption related transactions within the organization or not. Then finally, fraud triangle analytics, which is a new concept which is implemented in last 1 year, wherein you are using the concept of fraud triangle, which talks about why people commit fraud under a situation of pressure and where opportunities are available to them and where they are able to rationalize the act. Use those analytics to identify a potential fraud which is already happened or is going to happen. So this is sort of a predictive analytics to identify a potential fraud that might not have actually happened, but might happen in the next few days or few weeks. So this is a very interesting concept wherein you are not just looking at data, but you are also looking at emails and other factors, and I'll explain that in the next few slides. So in terms of duplicate payment analysis, there is enough examples available now industry-wide in terms of how do you identify duplicate payments through basically doing various kinds of analytics, including removing false positives and false negatives from this. What is important is to look at data from within the data set as well as from different data sets. For example, even though organizations are aware that there could be common employee and vendors, but very few organizations on a regular basis, unless they are very large and have a defined process, are doing analytics between the vendor master and the employee master. They are doing analytics within the employee master or within the vendor master, but between the employee master and vendor master, the analytics is not happening. To identify if there are common addresses, common bank account numbers or common PAN numbers, and you can identify conflict of interest situations. A very new sort of approach that is being adopted in order to again predict if a fraud is happening is monitoring employee behavior. Now this is a very sort of a different concept, wherein what organizations have started doing is to monitor the behavior of the employee through electronic footprint that an employee leaves by access to various systems that are provided by the organization to an employee, which could be emails, which could be accounting system, which could be say a travel system, which could be the messenger or chat system, phone records. So whatever facility is provided by the organization without intruding into the personal space or privacy of the individual, organizations have started analyzing their activities and comparing that with the transactions that those employees are responsible for, and proactively identifying if a fraud is happening or is supposed to happen. So what you are seeing here is who is talking to whom. For example, two individuals who have nothing to do with each other, suddenly you see a flurry of activity between those two individuals. They are talking about what? They are talking about a transaction, they are talking about something else. When? Are they talking regularly, talking only before office hours or subsequent to office hours? And why? And how do they feel? Is there sort of case? For example, we have seen examples where, say, around quarter end times, people will say that, oh, I'm anxious, right? They will say, oh, I'm feeling a lot of pressurized. So around specific areas, you use specific words to identify a potential fraudulent transaction that might be happening or might happen in a week or 2 weeks time. So this is a very sensitive area because unless you do it properly, you might intrude into personal privacy, which is not right, both from a legal perspective as well as from a organization's ethics and trust perspective. But without intruding into privacy, you can do a lot of things which will help you predict if a fraud is happening. The reason why I'm sharing all these examples is that going forward, you will have to use this, especially if you are a large organizations with multiple employees spread across multiple locations. You will have to use these methods, especially in sensitive roles and sensitive scenarios, in order to protect the organization against the frauds it can face. So what are the steps that are required from an investigation perspective? First and foremost is to understand the allegations. Second is preserve evidence. Now this is very important. What evidence is available? How do you preserve that evidence? How do you access that evidence is also important. An example is that if you are deciding that an employee laptop is required to be imaged and analyzed, unless you follow the procedures prescribed under IPC and IT Act, you might not be able to produce that evidence because the employee can claim that the evidence was tampered with. For example, when you take an image of the computers and you take a handover from the employee, you need to clearly capture through a chain of custody form and through hash value at what time the system was taken and what was the hash value. If you don't do that, then tomorrow the employee can claim that the evidence that you are producing was actually inserted in the system or was actually tampered with. So clearly identifying the evidence that could be available to you, which could be a phone record, which could be a computer, which could be hard copy, which could be data that is available in the employee desk, it could be anything. Clearly identifying and immediately preserving evidence is the second most important step in an investigation. Then interviewing personnel familiar with the underlying activity to understand the process and understanding what they are already aware in terms of the allegations. Reviewing the documents, reviewing the electronic evidence, then re-interviewing where it is required, then finally analyzing the evidence and developing the findings, including summarizing the modus operandi is critical. So I think in the interest of time now, since we have only 15 minutes, I will leave the floor open for question and answers. And I'll sort of close my discussion first by thanking you all for being attentive and then having patience. And if you can read a quote that I have picked up from a forensic perspective, which basically summarizes why we need to be more alert and make a beginning to make sure that we are ahead of the fraudsters.